In this breakdown, Wall Street Trapper explains why the market is entering a new phase as rate cuts move closer and the Federal Reserve quietly injects over 40 billion in liquidity back into the system. He connects these actions to historical market cycles, showing how shifts in monetary policy often signal the early stages of asset reflation. Let's check out this clip.
If you truly want to be in position from what just happened, this video will serve you well. The Federal Reserve just made a move that only happens before a major shift happens in the financial system, and 99% of investors haven't caught it yet. They didn't just cut rates, y'all. They quietly started buying assets again. We talking about $40 billion of fresh liquidity printed out of thin air that will be entering the system. And if you don't understand what this means, you better listen up, family, or you probably gonna get left behind. So in this video, we're gonna break down some key things for y'all that I truly think you need to understand. Now, I'm not saying we about to go into the next bull market that's gonna run us to the moon, but what I am saying, the Fed just put some new money in the market, and the market loves free money. Family, in our Sunday video, what did I say? When the Fed is gonna cut rates, we already know they're gonna do that. But the markets wanna know two things. Are you gonna cut in January, and are you gonna turn the money printers on? Well, the Fed just cut rates for the third time. That $40 billion in assets, money printer activated. And they just projected that GDP growth in 2026 will grow higher without unemployment coming down. That combination should not exist unless something real deep is happening and they don't want to let us know. So in this video, I'm breaking all of that down in a way that you can understand. And by the end of this video, y'all, I'm going to give you two ETFs that I truly believe will benefit from all this new liquidity without you having to go pick stocks, without you having to time the market, and without you gambling. So before we get into that, man, I want you to like, I want you to subscribe. I know that was a lot, but I need you to understand what's going on right now, and I need you to understand how we gonna lock in, y'all. So make sure you like, make sure you subscribe, and make sure you share this video with somebody, y'all. That's truly how to get this channel growing. I thank y'all for all y'all been doing. Let's at least get 1,000 likes on this video, y'all, so we can get go. Let's go. Something we already been saying. QT is officially over and the money printing season has begun. Now, what most people don't realize is how big this really is. So QT is when the Fed, quantitative tightening is when the Fed is draining liquidity from the market. What they're doing is actually taking money out of the system, right? QT simply means that we are now transitioning. And so let me just break it down to you so you can understand about the phases. It's the tightening phase, and we talked about this Sunday, and then there's the stabilization phase. And the next phase after the stabilization phase is always liquidity expansion and asset inflation. This is where we at right now, right? So stocks will move higher, growth companies will outperform, and then the market does begin another fade of acceleration, but only for the people who position themselves early. Everybody gets like stuck in this sphere when they hear the bad news, waiting for a crash that never truly develops the way it is because people keep saying it's gonna go lower. To me, that's just an emotional trap that every bull cycle has. Now, what we cannot deny that this is not a bull market. It is 100% a bull market. And what we gotta realize is, watch this, the market fell on November 21st, right? Since then, the market has gained $3 trillion, y'all. I'm saying it again. From December 20th, right before that Thanksgiving, the market has gained $3 trillion. So when we talk about the tightening phase, let's just understand that. How did tightening phase go? Because people be throwing it around on YouTube and on Instagram, and they don't really tell us like how that go. And that's what I like to do. I'll be wanting us to really be in the game and then understand how the game is being played from a deeper level. All right, so when we talk about the market tightening, what we talking about is the Fed saying when the market is tightening, the Fed is then selling their assets back to the market. So the Fed buys debt-backed markets, meaning they buy bonds and short-term securities. And so what the Fed often does is, when they're buying those bonds, right, they are putting liquidity into the market. And we're going to dig deeper into that because that's what the $40 billion is. But when they sell those bonds, now they have to get that money out of the market now. They have to give that money now back to the Fed. And then what the Fed does is they burn that. So now that's liquidity coming out of the market. So people always want to know, Trap, what do you mean by liquidity coming out of the market? That's what's happening. The Fed is actually, when the Fed said we are tightening, they're cashing in on the bond. That's how they shrink their balance sheet. So they had a $9 trillion balance sheet from COVID, right? That's buying assets. They were spending $60 billion a day of buying assets. That's how they flood money in the market. And then when they tighten, they start saying, you know what? Because it's short-term bonds, instead of me keep buying more bonds, what I'm going to do is I got to sell those bonds. So now, as they sell those bonds, that's how it goes from $9 trillion down to $6.3 or $6.4 trillion now. So now that's taking money out of the market, and then they burn that money, right? They get rid of that money. So that's what we mean by tightening is over, because now the Fed is saying they tighten. That stop. Look how quick this happened. They said December 1st it was gonna stop, and on December 12th they're gonna start back buying assets. And so when the Fed buys assets, usually short-term treasuries, what they buy, they then give that money to the banks. So now the Fed pay the banks with money that they print out of thin air. That's right, they just go print the money out of thin air and they buy bonds. These two things happen instantly. The Fed balance sheet increases, and then they are putting new money back into the market. Liquidity is the oxygen for the stock market. No liquidity, stocks kind of struggle. High liquidity, stocks go high. Now here's the strange part about it. When they asked the Fed why they're buying $40 billion in assets, the Fed said, well, we just preparing for April the 15th, which is tax season, and the reserves are kind of low. And so because reserves going to be low, we want to make sure we got money. Let's put that in perspective. We know they just did the liquidity injection of $13.5 billion. Well, that's telling us banks are short on cash. So the Fed is quietly doing what? Refilling the tank. Now, what I will say is this is not normal during stable times. This is not normal. They're seeing stress before the public sees it. You have the liquidity, and then you do a rush to put $40 billion in a bank. Like, you don't just say, yeah, we're going to do, like, yo, we're going to start Friday. Like, Friday? Like, this week Friday? Yes. So you stop printing money you stop tightening on the 1st, and on the 10th, you say on the 10th you cut rates, and on the 12th you're going to inject $40 billion into the banks. Not in January, because initially they were saying they was going to do it in January. They was like, nope, we're going to do it now. Now that's crazy. Now let's dig a little deeper to that. They then said that GDP is going to be up, but unemployment is not. That's a red flag. Higher GDP in 2026 is what they're going for, and they say about 2.3%. But they're saying unemployment not gonna move. That's kind of a contradiction, because that don't go like that. If the economy is growing faster, unemployment should fall, right? Because in order for the economy to grow, people got jobs, people got doing some things. Well, that's not what's happening. And when asked about it by Steve Leisman, Jerome Powell said it could be a little bit of AI, but we see the markets accelerating. Well, if that don't mean that, then productivity is rising fast. That should be hiring, but companies not hiring. More layoffs are happening, so the labor demand is weakening. Now, the Fed did say that if they see the labor demand weakening, then they'll cut rates again. But they said they was gonna pause rates. This is why I said I don't think we're gonna get into this like full year bull run. But it's a lot going on under the surface, y'all. Like, I'm gonna just be real. I'm always cautiously optimistic. You know, I am a bull, but I'm also aware of what's going on, and I want you all to be aware of what's going on too. So think about this. Like, let me just put this in perspective, because I always say in order for you to be a great investor or trader in the market, you got to know some type of like economics. So if the Fed says that they see, which they said in their report, right? They said that they see 2026 GDP growing, right? Gross domestic product, right? Goods and services, import, export. They say they see GDP growing. Well, if they see GDP growing, well, you should see unemployment declining, because in order for us to grow, that means people having more jobs, that means productivity is increasing, but they don't see that. They actually see unemployment rising, which tells us that we probably have a labor problem somewhere, which also says why we are seeing so many big companies use the word what? Efficiency. That is a scary word going into the future. Why? Because companies are taking huge layoffs, laying a lot of people off. Those jobs are not coming back. And so here's what the Fed said. Remember what I said in our video Sunday. That's why you gotta watch the Sunday recaps, because it prepares us for what's happening in the week. It takes everything that we do during the week, and then it prepares us for this week. Make sure y'all like and subscribe to this video, man. Make sure y'all share this out, because we definitely giving y'all some game right here. So remember I said in Sunday, I said, yo, we gonna have rate cuts this week. This is already priced in the market. Like, the market already know we're gonna get this rate cut. But what the market wants to hear is two things. One, are you gonna cut rates in January? Two, are you gonna turn the money printers off? Well, the Fed said it. Jerome played chess. He said, we need more data, but we likely gonna slow down on the cuts because of the labor market. But if we see the labor market falling, we definitely will cut rates again. Now, of course, we know Donald Trump said you should have cut rates by 50%. Why did Trump want a 50% rate cut again? Honestly, them jobs not coming back, y'all. This is why you need to learn how to trade. This is how you learn how to invest. This is why you need to learn how to start a business. You need to learn how to do this. I'm gonna keep pounding the table on that. It is imperative that you learn how to do this, because if you allow them to feed you, you get them permission to starve you. All right. The Fed said we only see one rate cut in 2026. Okay. But again, we will cut if we see the labor market weakening. Let me give you a translation. They don't trust the labor market. They see it's fragile, and they are preparing liquidity now to cushion the system. This is why the free money is coming out, y'all. So the free money is coming. It's a preparation for what's ahead. Now, how does liquidity enter the system? Let's dig into that a little bit more. Because I think people just make this way too complicated, right? And that's why I like that y'all trust me. So when the Fed buys assets, what they're doing is printing money out of nowhere. They just turn the machine on to print the money, and then they take the money and go buy assets from the bank, which they buy short-term bonds, right? And when they buy the bonds, the banks give them the bonds, short-term bonds, 60, 90 days, 6 months, something like that. But they say they're going to do a short-term this time, which is probably 30-day bonds is what they said. $40 billion of 30-day bonds. Now, let's be real. Do you think they're just going to buy bonds one time? Nope. You're probably going to do that $40 billion and then say, yeah, we're going to do another 40 right quick. Just to see. We're going to drop another 40 just to see. Right? So now when the Fed go print some money, hey, turn the machine on right quick. We need $40 billion. They go get that money. Let me show you this cycle right here. They go get that money. And then once they get that money, what they're going to then do is take that money, give it to the banks. And then the banks going to take that money and do whatever they want to do with it, right? They're going to flood the system with it. They're going to flood the market with it. But then after they do that, guess what's going to happen? Now, your money has lost more value. It has lost more value. All right, let's just go to the screen right quick and make this. Let me just show you how this goes. All right, so first and foremost, we got the Fed. All right, the Fed says we're going to print some money. Boom. $40 billion. And then from that $40 billion, now that money goes to the bank. All right. And then the bank in return gives the Fed, watch this, the bonds. So now what the Fed gets to do is increase their balance sheet. So now the Fed got the bond. So now here's what happens. Now the bank takes that money and they lend the money out. They then lend the money out to people, investors, put it in the market, Forex, and they buy other companies with it, right? And then the interest off that, they pay the Fed, they pocket some of the rest, and that's how that goes. Now, what does that do how does that help us? Well, what happens is the Fed now has more, watch this, bonds, and then that get bonds that don't get to go to China or Japan or other countries. So now, because what people don't know is that the Fed is the largest bond holder in the world. So that is protection for America, right? Because even though people keep saying China hold more bonds, no, they don't. The Fed owns more bonds than anybody. The Fed, the Fed owns more bonds than anybody. Japan and China are our biggest foreign holders of U.S. bonds. But the biggest holder of bonds is the Fed. So now the Fed, when they increase in their balance sheet, that's why I got IB right there. What they doing is holding those bonds, right? And so now what the banks do is take that interest, right? They take that interest. Well, they don't gotta pay the Fed. The Fed don't gotta cash that back in until whenever, but they do have to give the Fed the interest. So they do have to pay the Fed the interest, because that's what happens when you get a bond. When you get a bond, you get the interest on it while the bank holds your money. So the Fed is so dope because they get to print free money. Just imagine you get to go tell somebody, yeah, I won't get that. What you got? Let me go print some money right quick. And you just go print some money and give it. And that money is legit. So that's what happens right here. So that cash that they went printed, the cash that the Fed went printed, that they injected into the banking system, that becomes money now that goes back into the world, back into real estate, back into growth companies, back into, stocks, back. That's what the bank does with that money, right? And so that becomes liquidity into the market. Now, mind you, that's $40 billion. I can almost promise you that between now, January, and February, that ain't gonna be the last time we hear about the Fed putting money in the market. I can almost promise you that. And that's the free money. So if the Fed does that, and watch this, and we got lower rates. So now we got cheaper money, plus we got a $40 billion influx of cash. Now, mind you, 2 weeks ago, the Fed just injected what? 13 point something billion dollars. So that's $53 billion that just got injected into the banking system in less than a month. So when the Fed buys assets, they print money. Banks receive the money. Reserves increase. Liquidity rises. And then the market gets to breathe. Now, when the Fed sells assets, money leaves the system, liquidity falls, financial conditions tighten. Buying $40 billion is not a small action, but it's a signal, y'all. And these signals always show up in the market before they show up in the headlines. I'm going to say that again. The signals always show up in the market before it shows up in the headlines, y'all. And this is why we truly got to pay attention to things like this, right? Instead of just being like, oh, it's a bull market, it's a bear market. It's on us as investors to see what's going on. So why does this really matter to us? And this is why I want to speak directly to you. Most new investors, y'all, you lose money because you wait for permission. You waiting for clarity. You waiting for the perfect time to invest. Meanwhile, the wealthy, the experienced, and those who really been playing this game, they do the most investing during uncertainty. And they wait for everybody's spirits to get up and then they sell. Because uncertainty is where the discount is. And if you're scared of picking individual stocks, I still want you to be able to partake in the market. And that's where these two ETFs come in at. ETFs are really the cheat code for new investors. They low risk, they build diversification, and they expose you to strong companies, and you benefit from the tailwinds. We talked about what tailwinds is without needing to be perfect. So let me break down two ETFs for you that I think you'll really like. You'll thrive in these for sure, without a doubt. And I really want to help you out. So I wrote some stats down that I really want you to know, that I really want you to understand when it comes to these ETFs. So the first ETF is SPYG. It's a S&P 500 growth ETF, right? It's built for growth environments when falling rates, because growth companies benefit most from cheaper borrowing, right? You get a discount on future earnings and they become valuable. Liquidity pushes money through high quality company names for sure. And so the four top sectors is technology, 43%, communication services, 17%, consumer cyclicals, 11%, and then financial services, 10%. The top four companies inside of this is NVIDIA at 14%, Apple at 5%, Microsoft at 5%, and then Broadcom at 5%. Now the thing about this is these ETF, right, it gives you exposure to the leaders of the AI revolution without even having to pick a single stock. Now, let me dig into that a little more so, right? You want growth, but you want safety. Now, look at this for a second. I want you to really watch this, right? So, this ETF has 217 companies in it. It's up 21% year to date. And it's up 98% in 5 years. I want you to understand that's better than a lot of companies. It's outperforming the S&P 500. It's outperforming the NASDAQ. It's outperforming like 5 of the Mag 7 right now, right? And in 5 years, it's outperforming some of your favorite companies at 98%. So this next company I'm going to talk about is, this next ETF is IWF. This is the Russell growth. This is the big brother, right, to SPY, to the SPY. Now, it's 53% technology, 12% consumer cyclical, 12.59% communication, and 7% healthcare. You're going to laugh at me, but hear me out. It's 12.53% NVIDIA, 11.96% Apple, 10.53% Microsoft, and 5.39% NVIDIA. You like, Trap, that's the same top 4 companies. The difference is the percentage in the weightings of the top companies. The weightings are different. Now, IWF gives you long-term exposure to high-performing companies. Exactly the group that benefit from most from what? Liquidity. Now, this one has 396 companies inside of it. So it's smaller than the S&P 500, but bigger than the one we just talked about, right? Now, watch this. This one here is up 18.93% year to date, still bigger than, outperforming 5 of the S&P, 5 of the Mag 7. Watch this though. In 5 years is up 103%. So that's outperforming the first ETF, and it's actually outperforming some other companies, some of the major companies that we know and love, right? Now I want you to think about something. I want you to listen to me really close here. The biggest risk today is not a market crash. The biggest risk is being frozen while cash is being injected into the market during the next cycle. Rate cuts are one thing. For sure. We cannot deny that, y'all. But liquidity injections, balance sheet expansion, asset purchases, that's a whole nother thing. Those are real signals, y'all. And we just got all 3 of them in the same week. So I don't want you to overthink this moment. I want you to understand it. I want you to prepare for it. And I want you to position for it. And if we do that, you don't got to be perfect. I just need you to be present so we can get these profits. Man, let's build wealth the right way, man. It's your boy, the Wall Street Chapter, man. I love y'all. I appreciate y'all. Make sure you like, make sure you subscribe, make sure you share this channel, man. I hope you truly got some gain from this, because my goal is to help us turn our last names into an asset. So please share this out for me, man. I love y'all. I'll see y'all in the next one, man. Salute.